Hey everybody, Economic Ninja here. I'm so glad you're here with me on actually a quite momentous day. You're not going to see this the next day, but silver got just slammed down along with gold, along with a lot of things while the dollar spiked in value. And me and Andy were already talking about getting together and talking about the commercial mortgage-backed security issues. And I thought, you know what, let's do this today. So without further ado, Andy, how are you doing?
I'm pretty much out of breath, Trez. It's been a crazy day, really has. And there's a disconnection, if you will, between a price falling and extreme demand, like to the point where I bet you I've received close to 600 emails this morning. And so I think that the people out there, in large part for following guys like you, understand what this represents, that this is a subsidy and has really nothing to do with reality, a great departure from it, quite frankly, as far as I'm concerned.
Yeah, and before we get started, because this video is going to be on real estate, guys, but I do want to say I called Andy this morning. I said, hey, we could push this off to another day because you're about to get slammed. He goes, no, I got time for you. And I'm like, yeah, no, you're going to get slammed.
Yeah. It was definitely, you're definitely a fortune teller, because it's just gone exponentially crazy over the last few hours. It's a good thing, but I think people are waking up to what's happening and realize, much like the big money does, that when the price gets pulled down, it's an opportunity, it's a subsidy, because it's disconnected from reality. It really is. There's nothing realistically that should have pushed the price down the way that it has been.
Well, quite frankly, I was talking to David Morgan this morning, and I think that we're seeing a small liquidity event because of the Evergrande commercial mortgage-backed securities issue. And let me do this before we start with that. I just want to tell everyone I'm going to put Andy's email in the comment section in the links below. He has been absolutely crushing it for all of my subscribers. Generally, it looks like about 80 to 85% of the time, bring him the best deal you can find on any of the big online retailers. He is able to either match it or beat that price. And if he can't, well, good news. You just got a smoking deal. So thanks a lot, Andy. I appreciate that.
And I really appreciate the trust, man. And we're trying our best to bring the best price to your listeners. And hey, if we can't do it, I'll let them know. And there are sometimes a local coin shop or a dealer who's got a great deal, stuff that they pulled in at a great price, can offer the best price around. It's, offering the best price is not something that we have cornered the market on, but we certainly do our very, very best. And I think you're right. About 85% of the time, we'll be able to do it, at least for now, anyway.
Yeah. Okay. Let's jump into real estate. So about a month ago, I did a video about commercial mortgage-backed securities. And in that video, I stated, by January, you may not know what this term is today, but by January, I think everyone's going to be a professional in it, just like we saw everybody understanding what mortgage-backed securities were during the Great Recession. Well, today, about 3 to 4 weeks after that video started, we now start to see the Evergrande story coming into full effect. The term Lehman Brothers moment is being thrown out there. Quite frankly, I think that's mostly clickbait, even though this on a dollar basis is going to be, it looks like, larger than Lehman Brothers. But I think it's definitely a sign of times. And Andy had brought up something that he is starting to notice. And I wanted you to talk about that, and we'll go back and forth. What was that, Andy?
Yeah, that was a buddy of mine who is a real estate attorney here in Florida. And he had to keep going back and forth between his home office in New York City. And there was a ruling by a judge who basically said that as long as he works from home, he doesn't need to go into the city, that to do depositions or to be present, really, because of platforms like you and I are on right here, right now. And the discussion went a little further, and he said to me, Andy, you have no idea what this is doing to the real estate market, where not only that, he was told that it looks like in New York City, they're going to try to put into effect rent control, where buildings are 20 or 30% occupied. People are not going back to work. People are now being told legally that they can stay home, even in the case of lawyers who are representing clients in another city. Because of technology like this and what it is doing to the real estate market. He says, you have no idea what is happening out there. These buildings are nearly empty. They have very, very small occupancy, and that really you can carry this out further, and their employers and employees are both being incentivized to not come back. What that does to the buildings, what that does to the whole marketplace is very frightening if you think about it, because I think we are seeing a trend of people working remote. And when you have these massive buildings, which are massively leveraged with bank loans, you tell me, buddy, where does this end up? Where does this go? I think it is very, very frightening. And he is someone who he and I don't talk about what I do. We don't talk about economics that often. I just met him about 6 months ago or less, and but he said to me, listen, what's happening is truly frightening.
Yeah, and frightening is a good word for it, because there's already an official whistleblower case out there right now where somebody has been trying to alert the government about the fraudulent activities going on in commercial mortgage-backed securities. Some of the points of this whistleblower case are that these the rents are being over exaggerated. The projects, some of them aren't even being fully built out, where they'll be sold into a fund, and the let's say apartment complex is only 70% finished. And you have those issues, those lies behind the scenes sound very similar to what we heard back in 2007, 2008 with residential, but now couple that.
Say that.
Yeah,
sounds
now
the
that,
same.
couple that with what's going on with a nationwide slowdown, or at one point a stoppage in the economy, and hey, you don't even have to pay your bills. But look at this. We've got a story out of Bloomberg. I'm gonna link it below. And this is just this came out on September 3rd. It says San Francisco and Los Angeles office tower vacancies threaten CMBS loans. And they're stating a couple different addresses, 2025 Bush and 300 Montgomery Towers are losing tenants. That's cited from Morningstar. And then occupancy in Los Angeles building drops to 54% from 81%, analysts say. Now, and sorry, I don't want to go too long on this, Andy, but people need to realize that these commercial mortgage-backed securities are bundled in many different financial instruments, one of which I think is very serious, is pension funds. These pension funds take on these assets, and they need the yield to be able to pay their beneficiaries. And I think that these stories are going to start coming out more and more. And I want to put a parallel to this and what happened in 2008, because with precious metals, because we saw slowly the stock market start to erode, and then the paper price of gold and silver started to immediately erode with it until the end of Lehman, and then both precious metals, both gold and silver, skyrocketed to a multi-year bull run after that. But I think we're starting to see that right now, and today's smackdown, quite frankly, I think is a little alarming. That I think there's some hedge funds trying to sell insurance, raise dollars, quite frankly, because there is some fear in the market.
Yeah, I don't know what to make of that statement. Well, let me first draw a parallel. In 2008, the price of gold went from what did it go from? 1,200 to silver went from 21 to 9. Gold went from 1,000 to 700.
Yeah.
So we saw a 60% drop in silver almost overnight, and a 35% drop in gold almost overnight, and then it took off. But when that happened, what we saw was all the physical product in the world disappeared, literally. Every major mint in the world was out of product within a matter of weeks as the price got driven down. When I look at it now, I would say, yes, that's always the conventional wisdom, that it was a rush to liquidity, and that gold and silver represent immediate liquidity. And so you throw out the baby with the bathwater in that environment where you need to get liquidity. But when we look at what happened last August 9th, I think it was, just a few weeks ago, when the price of gold and silver got clobbered, we saw some very, very interesting things. We saw the commercial banks cover 66 million ounces of silver. We saw the commercial banks cover almost $5 billion worth of gold. And we saw one large whale on COMEX accumulate nearly 40,000 COMEX gold contracts. You're talking, 4 million ounces of gold. And you do the math, you're talking massive amounts of money that has just the footprint of one very, very wealthy trader that would have needed a $330 million margin account just to do that. And when you see the price fall again here today, you have to wonder, is he scooping more up? Is he coming in with more margin? I don't know. But the point I'm getting at is that it's very easy to make that statement that the price is being driven down because everyone's rushing to liquidity. And I think that's what the insiders want us to think. I would also like to think maybe, I believe anyway, that the commercial banks are using this type of a drop where it gets pushed down the ledge, gets hammered, and then it triggers all the stops along the way. Right now, there was a very large managed money trader position on COMEX, a very large one in the long category, and they all have stops that are triggered when the price falls with this much momentum below the moving averages, and they all sell, which begets more selling, which begets more selling, which drives down the price. And I guess we'll see on next week's Commitment of Traders report just what type of activity that actually begat, in the respect that I have a feeling that you'll see massive covering by the banks who are wickedly short, and more massive accumulation by the others. Now, the reference is, I do believe that in fact, I do know that this one big trader is not a commercial trader. It is a managed money trader in the others category. This is something I've been talking about for a long time. I guess what I'm simply getting at, Travis, on one hand, there probably is some selling to get liquid in an event like this, but there's also opportunities. I think that the big money are using these opportunities to not only get long, but to cover shorts. And I think we'll begin to see that more and more and more.
Yeah, let me jump in there. That's a great point. Because people are probably asking why they keep flip-flopping between real estate and Evergrande and then precious metals. What I'm trying to get people to understand is that we're watching derivatives implode right now before your eyes. And you're going to see the grand stage in the next few months to 6 months, I have a feeling. And what's going to happen is, just like in 2008, when these mortgage-backed securities were just bundled together, sold in all kinds of different funds, and the eruption happened, and then the systemic shock went out into the world, there was a rush for real things. Cash, which is great during a deflation, and then metals in fear of a hyperinflation event, right? Or just straight stability. And that's why I believe, like Andy's saying, these are opportunities to go to something real. There's a lot of people wanting to hold on to cash. There's a lot of people wanting to hold on to metals, like actual physical metals in your possession, because as the fake derivatives of this CMBS and Evergrande start to really come out, because trust me, Evergrande's been in problems for over a year. But now it's coming to the forefront where they're having to admit, we're not going to be making interest payments. This is getting rough. They just shut down all bond trading last night. The real events are going to happen in the next few months to half a year. What do you think about that, Andy?
Yeah, it's all interrelated. I mean, if you go back to 08, you remember they were talking about staring into the abyss, that they were very, very close to the whole system blowing up if AIG wouldn't have been bailed out. The systemic nature of all the financial markets are so incestuously tied together that you're right, that an event like this can trigger a systemic reaction where you have, especially with the derivatives, where the value of the derivatives are based upon a counterparty's ability to pay. And look, I mean, it brought down two of the biggest commercial banks in the world in 2008 with Bear Stearns and Lehman Brothers. So it is no joke. It should have brought down AIG, the biggest reinsurer in the world. It should have brought them down if not for a bailout by the government, and probably a lot of others that were bailed out. So when you talk about something like this, it is massively relevant. And in the macro perspective, everything is tied together nowadays. And that's really the issue when you talk about the leverage, the insurance, the reinsurance, and all of the banks that are tied together. And, you made one other comment I'd like to just to touch on for 1 second. You talk about gold and silver protecting you from a hyperinflationary event. I completely agree. But Doug Casey made famous a statement that if it turned out to be a massive deflation, like what we see with all this debt is very deflationary. It's that the government is fighting it tooth and nail with the printing press, which becomes inflationary. Whoever wins gold and silver are two of the only assets on the planet in terms of a deflationary hedge that are not simultaneously someone else's liability. And so when you talk about all of this counterparty risk involving derivatives and the complexity of the financial system, which is also so much systemically tied together, having gold and silver pull you out of that system because there is no counterparty risk when you hold something yourself. And I think that's important to bring up as well.
You know, and we'll end on this because that's a great point, because back in 2009, 2010, it's easy to, everybody would agree that while homes were falling in value, autos were falling in value, you know, you could go out on vacation super cheap because no one was going on vacations. Everything was deflating in price. Yet that is when we saw gold and silver start just crushing it from, you know, mid 2008 to well, October 2008 to the mid 2010. So you're 100% right. In deflationary times and hyperinflationary times, gold and silver is really proven to be a great thing to be into.
Absolutely. Absolutely. No, Travis, I think that the topics that you're bringing to the public are so huge, so relevant, and you do it in such an eloquent way that, you know, you bring a complex subject down to earth for people to understand. And I think the moral of the story for me is that everything is tied together nowadays. And especially when you look at all asset prices at all-time highs factored against all-time lows in interest rates. And you talk about an event like this where it is Asia's or China's Lehman moment or Bear Stearns moment. Look, bottom line is that you're going to see more and more events like this. And when you talk about real estate problems where they're all bundled together and sold, I wonder if we'll see someday that the group that, you know, the people that put these bundles together are now shorting it, just like we saw in 2008 with Paulson and the and Goldman Sachs and the what are they called, the mortgage-backed securities. So I guess we'll see. But look, bottom line is there's no question to me that these are all tied together. All of these things are very important to realize that, you know, we talk about events coming, and in 31 years, I've learned one thing: more often than not, you'll get the event right, but not what triggered it. In other words, when you base your decisions or your projections upon economics and mathematics, more often than not, when you sprinkle a little old school logic on it, you're going to come out with the right answer. Two things are almost impossible: when and how or what. And I'll tell you, you've brought some things to my attention, including the deal with Saudi Arabia and Russia, and then Nigeria. Two of the biggest things literally in the last decade that I have seen. And this is another thing: are all pieces of the puzzle coming together, and they're happening more and more frequently with greater velocity. And you know what? The moral of the story is people need to protect themselves, prepare, and get ready. Whatever you do, get out of debt, do the best you can to get some real assets, and realize that things are getting a little bit scary. No question about it, Travis.
Well, man, I think that's a great time to end, because I know you are you're already slammed, and I think it's going to get even worse as the day goes on. So thank you so much, Andy. I really appreciate it.
I will come back anytime you need me. It's a true honor and pleasure to take a very small part of what you're doing. So thanks for having me.
You're absolutely welcome. With that being said, guys, the Economic Ninja is out.